I always like to let panelists introduce themselves because I find they do a far better job than me. So I'll hand over to Nan first.
Okay, yeah. Hi, everyone. Just a short story. I started as a fund manager of tech in the tech industry, and then moved to mining. So I was managing kind of two mining funds in Paris. And at the time, one investing in precious metals and the other in energy metals. And we managed to actually label or get the ESG label for the mining funds. And also these are really the two only funds in Paris at that time who got the ESG label. And now, so what I'm doing since I moved here in Hong Kong is founded the company called GaiaMine. Because during my experience with the mining fund management, what I found is the mining industry is just too small for a lot of investors. So just example is when you look at the NVIDIA kind of market cap drop during just one day is 600 billion. And probably this is the total market cap of the whole industry. So there's kind of investor, I think, pool. And then secondly, there's also, let's say, the ESG kind of constraint. So that's how I had the idea of creating GaiaMine. So the idea is really to get more investors involved in it. And we cannot deny the fact, like, if we're talking about energy transition, mines matter. So that's why we are here, yeah.
Over to Ali.
Yeah, well, to begin with, Lucy, you're doing a great job at emceeing. So
Thank you.
Well done, and a big congrats to Alex, Kim, and the team on a great conference. Bit about me. So I'm Ali Ukani. I run the ESG investments division at Peak Asset Management. Alex has been kind enough to put our logo on the banner, so that's why I'm here, I guess. But we essentially are a Melbourne-based boutique asset management firm, and we run a co-investment model, so back all of our deals with principal capital. As a business, we are sector agnostic, but I'd say that we do look at various ESG-oriented investment verticals. So some of the sectors that we look at primarily form life sciences, tech, deep tech, industrials, and the like. I'd say typically we work with businesses that are small or micro caps, ASX listed, and we do look at a number of private deals as well. But we've got to, take big positions sometimes. Yeah. So personally, I come from a consulting background, and I've been running the ESG investments division at Peak for about 5 years. So pleasure to be here.
Thank you.
And Dr. Frederik?
Yeah, thanks, Lucy. Yeah, first of all, let me also thanks to Alex and the Ignite partners. The organization here has been really good. So it's a pleasure to be here today, even though it's I guess the last panel for the day. So I hope we can share some interesting thoughts and ideas after the energy transition panel this morning. So I'm Frederik. I'm working for a company based in Hong Kong and Singapore called Audacy. We are an early stage investor in companies that are in the climate tech space. By that, we invest into energy efficiency, transportation a lot. We invest in industrial decarbonization. So since 2017, we have invested into companies that are in hydrogen, second life batteries, sustainable aviation fuels, a lot of recycling companies for fuels, but also in sort of waste to energy products. Personally, my background is in science. I am the head of science for Audacy, so that kind of nicely brings me back to my first half of my professional career. I studied physics first in Germany, later in Hong Kong. I did a PhD on solar cell technologies, so new materials for more efficient solar cells. And since then, basically worked in ESG. So started my career in Hong Kong, which is an organization that back then was called ASRIA, which is the Association for Sustainable and Responsible Investing in Asia, which is now UNPRI, so Principle of Responsible Investment. And then was fortunate to join and have helped building up a company that was building solar projects in Japan in 2015, which was a great opportunity after the Fukushima accident and the feed-in tariff that was built there. And through that opportunity, I got to meet Audacy in 2017 when we started. And since, and I think that's something we're going to talk about today, the cost of solar has come down. We see a lot of other technology following sort of a similar pathway, and in parallel to that, then I and Audacy moved earlier stage to invest into companies that are sort of follow or investing into technologies that likely going to follow the solar path. So yeah, that's us. Looking forward to the conversation.
Thank you, all of you. So the title of this panel is Driving Value and Sustainable Growth, and I have to acknowledge that's a huge topic to try and cover in 35 minutes, but we're going to do our best. And so I wanted to start with kind of a broad question to throw out to all of our panelists. Whatever sector you're in, ESG is a critical lens when consider when you're investing. So from all of your perspectives, what does driving value and sustainable growth truly mean, and how do you see this evolving over the next 5 to 10 years? Frederik, do you want to start?
Yeah, sure. Yeah, I mean, obviously the term ESG keeps evolving, and yeah, back then when I started with Azaria, it was called sustainability investing. Then it was ESG for a long time, and I think something we're going to talk about probably towards the end of our conversation is also what's happening in the US and what's happening globally, and the pushback that ESG is getting. But one thing that I learned, and has been a fundamental thesis ever since getting into the space, was that the fundamentally technology always going to beat commodities and speed and cost. So for us, really investing into sustainability is really a financial question. So if a solution is better, it's cheaper, and on top of it, it also reduces emissions or it reduces waste, that sort of is a cherry on the top. Really what we're looking for is a financial returns, and that makes it sustainable. So for us, sustainability is really more of a question of, is this solution better? Maybe it's not better and cheaper today. As I mentioned, technologies have learning curves. So for solar, what we see at the moment, with every doubling of capacity, you get a reduction in cost of 15 to 20%, and that's substantial, right? So solar costs have crashed, call it 90% over the last decade. And again, a lot of these technologies that we are investing in are going to follow a similar path. So yeah, I mean, for us, sustainability is less about sort of frameworks and sort of ticking boxes. Is really a financial return into solutions that are cheaper.
And Ali, from your perspective, I know that mining and resources are two or three of the top sectors you invest in, so it's really interesting to hear your take.
Yeah, I mean, look, I think some of the points that Frederik raised pretty important. I mean, because we primarily look at a lot of small and micro cap companies, they don't have any voluntary disclosures at the moment because it's not mandatory for them. And typically speaking, it's either too complicated or too expensive. And therefore, there isn't a whole lot of readily available data to guide our decision making. And so I guess what we look at when it comes to ESG is how integral is it as a core competency in your business rather than a branding exercise. I think that the top three verticals for us in terms of investing are obviously resources, as you pointed out, but also life sciences and tech and industrials. And when we do look at a lot of companies that are smaller, it comes down to are they addressing an unmet need that then has some sort of an impact? And I think a good guiding principle that we often take is a triple bottom line approach. So can we make an impact on people, planet, and profit? Because at the end of the day, if it doesn't achieve economics of scale and it's not economical, it won't impact the other two P's. So I suppose that's sort of how we look at it.
And Nan, from your perspective?
Yeah, I agree. I think I agree with Ali and also Frederik. But I'll take this opportunity to redefine the ESG. I think everyone here knows ESG means environmental, social, and governance, right? So I think now we're come to ESG 2.0. So what I just talked about, I think we're at a 1.0. So now the ESG we're talking about outside is energy, asset security, and third, I'm sorry, that would be a French word. It will be guerre. So it means war because we are in an era of war. So in an ESG 2.0, what's really important, I think what Ali and Frederik said is we have to be sustainable, of course, to drive value, superior returns to the final investors. And second, also to create a circular economy to basically guarantee the security of each country. So for that, that's why I think, that's basically what drives us to do. Because what's interesting, I just said in the intro, right? I was a fund manager of a mining fund, and usually the mining industry is excluded from ESG funds because they're not ESG compliant. But when we did all the ESG process, what we found is it's just the ticking boxes. So I think we have to kind of leave the ticking box words, but more make really the ESG, as what it's just said, bring or drive value and sustainable growth. And what we basically are, or the mission of GaiaMine is also to use the technology. To your point, I think, Frederik, it's can drive a lot of value. There's one technology, I think, which can bring really a lot in the ESG 2.0 we're talking about, is blockchain. We need to bring transparency to a sector. And the ESG 2.0, we cannot leave without mining industry, because if we have to achieve carbon neutrality, mines, do matter.
I think that's really interesting, particularly what you say about the tick box exercises as well, because I think that's something, unfortunately, we see not just in like life sciences and tech, we see it across all sectors. Also interesting what you said about mining being excluded. I think the resources, metals and mining sector is often seen as perhaps behind compared to other sectors. So I would like to ask all of you again, like, what are the biggest misconceptions about ESG in the sector? And how can companies and investors work together to kind of change that narrative?
Yeah, sure. Well, I think the starting point really should be that what was discussed in the first panel today about the energy transition, that really we can't have an energy transition with a lot of those minerals that the mining industry is getting off the ground. And that's certainly true for copper. That's true for aluminium. I think it was discussed this morning that for electric vehicles, for renewables, probably one of the best bet out there is that we still rely on copper, and then for the foreseeable future will be, because superconductors and all, there are a lot of ideas out there, but it's really clearly copper that's driving the electrons at the moment. And to your point, Nan, it's kind of ironic then to exclude that sector, given that it's so fundamental to the transition that's happening. So that's sort of that should be the starting point. But of course, I mean, there are environmental issues, right, with some of them, some sectors in the mining. I think, again, the point in cooperation should be, the starting point should be we need those minerals. We need mining, right? It's the same for fossil fuels. Like we simply can't just replace fossil fuels, within a day or so. So like the starting from that, and then to see what we can do in terms of technologies in the digital space. How can we use AI? How can we improve the supply chain in the mining sector? Then the mining sector is driving the adoption of renewables a lot. So I think that's a part that's helping. And then we see startups that are actually developing better chemical processes. One thing we like a lot is advanced materials. We have been talking to an Australian company that's producing lightweight materials for transporting minerals out of the mines. And that obviously improves, right? Again, the point not being replacing mining, but how can you make it more efficient and more environmental friendly?
Yeah, I can jump on that. Definitely that part. And I think the first also is the mining industry is just so small, right? The total market, which is only a quarter of Apple's market cap. So when most of the mining companies, they cannot pay, let's say, MCI or the leading agencies to rate them because it will cost them 10K or 20K USD, they are not covered. And in the mainstream investor or pension funds, they use the screening to get their list. So one, I think, is about coverage. And second, I think also usually when we're kind of the best students in a class, we're only look at the top tier. So now the industry is more focusing on best in class. We look at the best performance of a sector, and we don't look at best in effort. So maybe we should have a best in effort for the mining companies. And third, I think there's the cause, which is the ticking box methodology, which has been used. So for example, when I look at all the mining companies and the auditors ask me, okay, are they all signatures of global UN global compacts? So I ask all the mining companies we invest in, say, okay, why are you not? And they said, actually, we cannot because we're pre-revenue companies. And to be a signature, we have to generating revenue. So that means 80% of the mining space, so juniors, explorers, or developers, they're excluded from this. Yeah. So I think these are the three observations I had when I was managing the fund. Yeah.
I mean, that's really interesting to hear. And I think, Frederik and Ali, you mentioned both in my first questions, your answer to my first question, sorry, the importance of profitability and the economic factors and how that really is key. Ali, I was wondering, many investors still perceive ESG as a trade-off between profitability and sustainability. How do you communicate the business case for ESG to stakeholders, particularly in a sector as capital intensive as mining is?
Yeah, look, I think it's an interesting question. When it comes to broad adoption of ESG, and pardon my colloquialism here, but I feel like if the lefties learn to commercialize it, it'd be game over for everyone. Because this idea that if you're a sustainable company, that you're going to keep burning cash and not really make business sense, I don't think that's an entirely true notion. Within the context of mining, just going back to that, I feel that mining companies sometimes get a bit misconstrued. For instance, there's quite a bit of work that mining companies have been doing for a number of years that would be considered as corporate social responsibility or otherwise, which now can be put under the ESG bucket. But if you are like, for example, we invest in a number of companies on the ASX that have offshore operations, whether that's in South America or parts of Africa or otherwise. And in a number of these jurisdictions, the companies always look to engage local communities. They do look to build a certain amount of infrastructure, create a number of jobs. So there is a bit of a process around this. I do think that it hasn't been codified well enough. And I think that's where the opportunity is, because when we do look at sort of the ASX, and there's about 2,300 companies that are listed on the ASX, typically about, maybe 20% of them are reporting at this point in time. And so 80% are not really. And the reason for that is that we haven't really created an environment where they can present this readily available information. So I think there's a bit of opportunity there. And at the end of the day, the average retail investor will realize that it does have a material impact on return on investment, which is the bottom line. So.
Yeah, just thank you, Ali. Just to add to this, I think it's part of the dynamic that's going on here is that for a while over the last 5 to 7 years, ESG was just slapped on pretty much anything, right? Like you could have a regular fund and then you just added ESG and for an ETF, and suddenly there is money flowing into the ETF, and of course, and if it's a great marketing tool, people will continue to use it, right? And that also means that pretty much anything became ESG, and you kind of lose the focus and the definition of what ESG was and probably what it should be. So I think sort of that backlash that was kind of expected, because you had some projects that were clearly not very environmental friendly and still got sort of that ESG label. I think the really important part is what Ali just said about scalability. So if you really want to have an impact, you need your solution to reach a very big scale, right? You think about the the amount of CO2 emissions we have, the amount of CO2 emissions that we need to abate in order to have sort of any chance to avoid the worst impact of climate change, you really need to scale, and you need to scale up quickly, kind of what we saw in solar. So you need the exponential growth to really scale up. And again, you only achieve that not by calling it ESG, you achieve that by making these solutions cheaper. And it always goes back to that fundamental sort of, if something is cheaper, it's better, then sort of by definition, it's ESG. And I think that's a better way to do it rather than calling something ESG and sort of trying to fix it into that box.
Yeah. I mean, I think so. Like just to chime in here, because we look at a lot of early stage technology businesses, and typically the focus of a technology business is on the technology and not the business. And I think that's where sometimes they go wrong, is, try and focus a bit on the business aspect, because if you can't solve that, the technology is not going to really work. And if you look at solar, it's a great example, because solar panels have been at around 20 to 30% efficiency for probably about 20, 30 odd years. That's not to say that there isn't other emerging technologies that can make them more efficient, but it's more so that they haven't been really thought through in terms of scale and unit economics, which I think is super important.
If I can just add something on that, I think scalability then definitely is a very important factor. And second, it's probably independence. The issue with the ESG rating is just it's not independent. So a company rated A, another company rated D, and when we look at the performance over the past 10 years, it's completely opposite. And why is that? Again, if we take the mining industry as an example, is they will look at the emissions, CO2, right? But they'll look at only scope 1 and 2, but they don't look at scope 3. And scope 3 is 80% or even more than 80% of total emissions. And second would be they'll look at the social, let's say, women percentage of the board. Definitely that's important, but sometimes it just doesn't apply to the sector. Myself, I'm female, but I know a lot of females don't want to work in the mining industry, and they just not made for them, right? So you cannot apply that, and then so maybe more important is more the social part is accidents on the site. So I think that the issue here is also I do believe profitability can go with hand in hand with sustainability. It's more kind of what are the principles we're using to do that.
Thank you all for your perspectives. I mean, Nan, I'm going to come straight back to you. Obviously, GaiaMine operates at the intersection of tech and natural resources, and you've touched on this already, mentioning blockchain, but it would be great to understand a little bit more about how you see technology transforming the mining sector's approach to ESG and where you think it is still underserved.
Yeah, I think technology brings to, Frederik and also Alice's point is scalability. So technology brings access. When I'm in Paris, a mining company come to see us. Probably there's less than 10 institutional investors who are interested. With the technology, blockchain, tokenization, we enlarge the investor space. When we look at the crypto market, how the crypto market rallied or grow over the past few years versus gold investment, it's amazing. Right. So why don't we use crypto as means of transfer, as means of currency to grow the investor base of the mining investment? And also the technology blockchain is we bring transparency, make people liable. The management team or mining management team, they work for shareholders. They don't work for their own pocket, right? So we would love to bring transparency to the sector, and that technology can bring. And also liquidity. A lot of companies, when they are listed on the ASX or TSX, we still have to go through specific brokers to trade. But with technology, we can do peer-to-peer transactions. So that brings liquidity and that brings appetite. So hopefully one day, I want to see the mining industry plus derivatives market will grow as big as a tech industry.
Thank you, Nan. Ali, Frederik, do you have anything to add?
Yeah, I mean, I think there's quite a bit of opportunity in terms of technology and mining. I think when you look at mining, you really have to look at it from a life cycle standpoint. I think that when we do look at mining, typically we think of it as something that goes through exploration, development, production, processing, and consumption. I think that it's sort of a very simplistic view of looking at things, especially if you look at battery materials. I think the supply chain doesn't end at consumption. In fact, that's only half the journey. So if you look at a life cycle assessment that's cradle to cradle or cradle to grave, then you've got to consider what happens end of life. How can you make that process more efficient? So, for example, one of our portfolio companies is here. They do end of life battery recycling and battery material extraction. And I think that it comes down to, if you look at, going back to grade school, we all learned the simple principles are reduce, reuse, and recycle. So the first one's to reduce, right? So if we can reduce and if we can reuse what's already out there, we can make the process more efficient, we can make it more economical, and we can make it more scalable. And if we can do that, then we can make it cheaper, we can make it faster, and essentially something that's broadly applicable. So if you look at technology at the start of a mining process, there's a lot of ways to decarbonize the actual equipment. There's a lot of ways to decarbonize the mine site. If you look at it from a processing standpoint, there's quite a bit of usage of caustic substances in the processing part, which you can definitely work on. So we are invested in a private company, for example, that's in the ultra high purity quartz space, which traditionally uses a lot of acid. But this company is doing it without the use of any acid. And so it's cheaper, but also more sustainable. And I think, when you think of mining, taking a simplistic view really narrows the opportunity. And when we look at technology and innovation within the mining space, I think there's lots of money to be made by taking a bigger life cycle view.
Yeah, not much to add there. I mean, it's really a technology adoption that we see across these different sectors. And I think the advantage is really that because of the scale that the energy transition is going through, again, the interest in copper and aluminum and other materials is just growing and keeps on growing. And so that already shines a lot of light on some of these issues, and again also incentivize companies to develop solutions, because then right away there's a market for them to sell into. I mean, we see it in sort of adjacent sectors. Geothermal is a sector we're looking into, obviously driven by the energy demand from data centers. We do see people moving over from sort of more the oil and gas space, because it is so close, moving over and bringing the best practice from there into geothermal. But even within geothermal, there are some interesting developments, how the drilling works. So sort of using a mechanical drill, you start using probably laser or more heat to make it more sustainable. So again, I think the biggest advantage of it is that a lot of these sectors, not all of them, but within mining, a lot of them get a lot of attention, are definitely growing. And so again, there's a big market to sell into.
I think one thing, when we were preparing for this panel and having discussions, one thing that really struck me was reporting came up, but from a different perspective for each of our panelists. Nan's smiling because she knows what I'm going to ask, and I know that Nan's really passionate about this as well, but I'm not going to go to you first. I think, Frederik, from the perspective of investing in early stage companies, there's a lack of data. So what frameworks do you have in place to tackle this, and do you set targets for companies? Like, how would you approach this from your perspective?
Yeah, I mean, definitely that was exactly the question that we asked ourselves when we set up our fund. What is out there? So the truth is there are a lot of frameworks out there, and people put these things on LinkedIn, like all the environmental frameworks and ESG frameworks, including PRI and TCFD, and you're probably very familiar with all the acronyms. What we found at the end of the day is that none of them really fit for what we're investing in. And it's the same for our peers. So we're investing in early stage companies where there's a huge potential to reduce CO2 emissions or greenhouse gas emissions or other impacts. But again, from day one, they're still commercializing and building up that technology. So Some funds have resorted to sort of set a specific goal by, let's say, 2030, so and so much CO2 that they want to avoid. What we ended up doing is setting up our own impact investment framework. So we consulted with groups outside, really try to understand best practice. Because one thing that we also need to keep in mind is that when we are investing, we're also a minority shareholder. So, and there are lots of others, right? We invest with a lot of strategic investors, with the likes of Airbus and Qantas. So if these companies that are already sort of constrained in their manpower and in their resources, being asked by dozens of investors to fill out reporting forms from each investor individually, that's just going to overload them. So we kind of took a pragmatic approach and basically work with the companies to go to a sort of a unified reporting standard and to help them with that, rather than just sort of dumping a standard on them and trying to fit them into that box.
And I mean, Ali, operating in the small cap space, you've mentioned already, reporting is somewhat limited. So how do you tackle this, and what do you look for in lieu of this?
Well, reporting is limited, if at all existent. But look, I think I'd probably go back to my first response in that we typically tend to look at how integral is this to the core competency of your business, and to what degree can your operations actually have an impact on the broader industry and obviously investment returns. So I think one of the things that we look at, given that we're to an extent generalist investors, we do look at specialist investors. So for instance, when we're investing in, let's say life sciences, I think that within the life sciences space, the impact of ESG, just from a typical box ticking framework, isn't fairly well understood. But if you look at it from a tangible impact on social especially, it can be pretty profound. So some of the companies that we invest in, for instance, they would go after often designated diseases. And what those are basically diseases where there's no current line of treatment, there's no current standard of care. And so there's a pretty big unmet need. That being said, we're not specialist investors. So my go-to approach would be to go and look for one. And so in our due diligence process, we typically will bring in an external expert for due diligence. We will look at an overall viability of the asset and commercialization of it. And that would be a typical guiding light for the investment decision making. So I think it's more sort of looking at what is this company doing? How well can they commercialize it? And once they do reach scale, what sort of impact will it actually have across some pillars of the ESG space?
If I can just add something.
I was going to say, Nan, go ahead. Go crazy.
I think my recommendation are we agree too many frameworks. I think probably we should adopt tier 2 systems. If for the financial reports we have GAAP and IFRS, why can't we have one single framework for global standards? As of today, the major economies, they're using the ESG framework as a economic wall rather than for really driving the sustainable growth. So that's, I would say, tier 1, if we can have a global standards. Second, I would say we need deregulation for the small companies for them to make innovation. I was IR responsible officer of a type 9 kind of asset manager here in Hong Kong. And I say, wow, it's really a lot of compliance work to do. So, maybe we need some deregulation in certain market. Yeah. So that's my view.
Thank you, Nan. And I think we can't really have an ESG panel without acknowledging wider influences. What's coming, guys. Environmental policy and activity. Especially with the changes we've seen in the US administration. It's always interesting to look at this, but I think particularly given, we're in Hong Kong, from an Asian lens, it would be really interesting to understand, Frederik, perhaps your thoughts on how it is impacting ESG over here.
Yeah, thank you. I guess it's very interesting to see how that evolved over time. So, 10 years ago, sort of in terms of ESG exposure and sort of who was leading, who was setting the guidelines, was clearly the US. So when we worked in trying to adopt some of these standards and the frameworks in Asia, it was clearly looking what the US is doing, like even in terms of what the SEC was doing, like sort of pushing that agenda. Again, it has evolved over time, and arguably it had gone in the wrong direction. So probably a correction in that sense was overdue, and then clearly that's what we're seeing in the US now, whereas sort of the anti-woke, anti-ESG that's happening. It's a reality, right? You can look at what BlackRock is doing, how the rhetoric of Larry Fink has changed. So I mean, that's a reality that we live in. Personally, I would say I'm more concerned about the uncertainty that creates. So if it's tariffs of 25% one day and then overnight they're being replaced, and then it's only I think that the uncertainty is really what causing the issues at the moment. Again, and then we just go back to fundamentals, right? Like even within the Trump administration, we know that a lot of the Inflation Reduction Act is not going to be reduced for the simple reason that 80% of the funding goes to states that are governed by the Republican Party. So I think sort of with all the sort of stuff that's being talked about, if you really look into the details, again, the fundamentals haven't really changed. I mean, Texas has been building 95% of the capacity that was added recently in terms of electricity generation was all renewables in Texas because it's cheaper. So again, my concern is more the current uncertainty, and I guess my hope is it will sort of get better once the administration is fully established and sort of has found its way. But then again, we can go back to talk about the fundamentals, and for me, they haven't changed.
Thanks, Frederik. Sorry, Ali, Nan, do you have anything to add?
I mean, I would say that politics and ESG, it's always interesting. I think if ESG were a person, they probably need a better publicist, is what I would say.
I would agree.
I think with a lot of what's happening that we see in the news today, it's pretty insular. So there's two camps. There's people who understand ESG and knowledge specialists, and everyone else. And I think that if you create a situation like that, the human nature is that we tend to refuse what we don't understand. And if you don't simplify something or codify something that's in a way that the average person can understand, they will tend to refuse that idea. And I think what the US administration is doing really well is simplifying messaging and targeting it towards an audience in a very sort of explain it like I'm five kind of way, which ESG guys just can't do or haven't done. So I think when you look at ESG and politics, it just comes down to, I think what Frederik's saying is interesting, right? Because there's a lot of core fundamental things that are really good. So solar's really efficient. There's many ways to decarbonize gas. Nuclear is really efficient. And there's ways to essentially decarbonize our baseload energy because that is obviously going to feed into flow-on industries, whether that's data centers or consumption or household consumption or industrials. So I think our politicians probably don't understand it well enough because we haven't done a good enough job to simplify it for them. So that's where we should begin.
Yeah, I completely agree with Sally. I think also we have to do more research on ESG. The issue now is when we look at fund industry, all ESG funds, they underperform our non-ESG funds. Why is that? So maybe we should do more research on the correlation between the ESG indicators and the financial performance first. And second is like, there's a good analogy. I think it's like economics, right? When J. Paul was saying, my inflation target rate is 2%. Then why 2%? So I think eventually we have to do more research on this.
Thank you all. And unfortunately, we were almost out of time. And as the person in charge of timekeeping for this conference, I can't ironically go over my own clock. I just want to say a huge thank you to Nan, Frederik, and Ali for taking part in our last panel of the conference today. It's been an absolute delight. And thank you for answering all my questions so eloquently. A round of applause for our panelists.